Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by my company, Bull Realty. Hey, we sell commercial properties, lease commercial properties all throughout the Southeast, senior housing, hotel, industrial, retail, office, everything. We'd like to be your single point of contact. If you need a broker, you need a developer, whatever you need anywhere around the country, real estate lawyer, let us know and we'll hook you up with the right folks. I have an easy email to remember. It's michael@bullrealty.com. Well, we have a great show for you today. We're going to talk about industrial real estate. And, I love industrial real estate. I've been in business a long time. And I remember when I started, the industrial folks in the sector were the dirty shoes, jumping around, no spec building, really conservative. And then of course things have changed over the last several years, right? The industrial real estate really took off, and values really skyrocketed, and rents went up. Lots and lots of demand and future demand expected. But has it cooled off a little? There's still opportunities in industrial real estate. What are we seeing for rents, rates, and vacancy around the country? It's seen a couple times in the headlines where you hear there's a lot of big boxes available. What's the story? Well, let's find out. Please welcome my guest. It's Ermengarde Jabir. She's senior economist with Moody's Analytics. Ermengarde, good to see you. Thanks for joining us.
Good to see you as well, Michael. Thank you very much for inviting me back to your show.
Thank you. And the first question I think my audience has for you is really, how is industrial properties, how are they overall performing around the country? It seems rents really shot up and values really shot up, and things were going well. Where are we now here at the end of 2024?
So yes, they definitely, had a moment of exponential growth, and the moment lasted for a reasonably long time, in the region of 2-ish years. But we have started to see a cool down, certainly through the end of last year into this year. But what we have experienced sort of now in the third quarter, and what we're expecting for the fourth quarter, so really the second half of 2024, is quite a bit of an uptick in terms of rent growth. So sort of to put it into context, if we just look at 2024 alone, what we've seen is that rent growth for distribution warehouse, for example, was 0.7% in the third quarter, which, of course, if you compare it to the outsized growth that we saw in 2021, 2022, that pales in comparison. However, that figure is the same as the sum of the rent growth in the first half of this year, so the first half of 2024. And so really what that's showing us is that there is a bit of an uptick from that perspective in the industrial sector as we move through the second half of the year.
Yeah, and go ahead.
No, I was just going to touch on vacancy briefly. Yeah. Having said that, we have also seen a relatively steady uptick in vacancy over the past several quarters. For, again, warehouse distribution, we now stand at about 6.7% in terms of vacancy, which is higher than it has been in recent quarters and years. Again, higher than the record lows and the mid to high fours. But again, if we comparatively look at that in the context of the historic figures for industrial, distribution warehouse vacancy rates on average per quarter, prior to 2021 were north of 11%. So we're not quite half of that, but, we are much, much lower than historically. So the sector's still doing extremely well in a historic comparison basis.
Yeah, well, that's good to hear. And what do you expect moving forward?
So this year, through the end of this year, we're definitely expecting that the sector will continue to recalibrate, as it were, really, continue to find its footing, because of course, and perhaps I've said this on your show before, but forgive me if I'm repeating myself, exponential growth isn't sustainable in the long run. It is normal that the sector is finding its new footing, its new equilibrium, its new steady state. And so, in doing so, naturally annual rent growths will be lower. So for this year, we're expecting in the mid 2% for the year total. And then vacancy rate is expected to tick up just slightly to about 6.8% to end the year. But I think the more interesting story is really, what will happen next year, and that's really where the sector is going to start its move to its new equilibrium. So essentially, vacancy rates will start to come down, um, in the neighborhood of 6%. And then, if we look at a 5-year forecast period, a 10-year forecast period, there is the expectation that the vacancy rate will be closer to 5% and possibly even sub 5% in the coming years. And then from a rent growth perspective, that equilibrium annual rent growth is really expected to be in the neighborhood of 3 to 4% across industrial. So whether you're looking at warehouse distribution properties or flex R&D properties.
And Ermengarde, what are the factors? What's going on out there that will help industrial real estate get that performance in 2026 and 2025?
Mm-hmm. So really, it's the continued growth of e-commerce.
Okay.
And that's really an area where we have seen exponential growth over the past 20, 25 years, and where it is expected to continue growing. So the share of e-commerce retail of total retail sales continues to grow. Of course, it peaked in the second quarter of 2020 out of necessity, but its current figure is the second highest on record. The second quarter of 2020 being the record, and so that is really a big source of growth from a storage, shipping, packaging, processing perspective. However, having said that, there is a bit of a headwind in the storage aspect of warehouse R&D or warehouse distribution rather, for goods. And that's really because what we are seeing a lot of retailers doing, and Home Depot is a big example of this, is that they've transitioned their inventory structures. So due to a lot of supply chain issues brought on by the pandemic, brought on by inflation, increasing prices and all of that, what we did see is that retailers were storing a lot of goods in anticipation of future demand. And right now they're switching quite substantially to more of a just-in-time inventory system where they're just stocking the goods that they need for the moment to sell instead of really storing. And so that from that perspective, there will be a bit of a shift. But certainly, if we think about e-commerce being a major tailwind, that will certainly continue.
Yeah. And what about onshoring? Do you expect more manufacturing to come back into the U.S. and impact industrial real estate?
Yeah. So reshoring and nearshoring have been big tailwinds for the industrial sector, just from, as you mentioned, the manufacturing perspective, really trying to bring manufacturing back to the U.S. And a lot of that, again, was driven by the fact that supply chains were severely disrupted by the pandemic. But what we have seen in this past year in 2024 is that, again, there has been a shift. And, the reality is that the fact that it takes a long time, and naturally so, to move manufacturing processes, back to the U.S. Has meant that sort of the fervor behind nearshoring and reshoring has cooled pretty substantially. And so, of course, that's not to say that in the future there might not be, more incentives for nearshoring and reshoring. But at the moment, the strong tailwind that was behind that has certainly cooled.
Yeah. It seems like in most sectors of commercial real estate, new supply has really slowed down over the last few years. So deliveries of new product. We expect to continue to be slow. What about though industrial? I mean, industrial has been such a darling sector. What do you see for new supply and the impact there?
Yeah, so we have seen a pretty significant slowdown
Mhm.
in completions in the industrial sector. And one can look at it sort of in the positive light, which is really that, the fact that there has been a slowdown has meant that, vacancy rates haven't necessarily skyrocketed given slowing demand. It's helped effective rents continue to be positive and even pick up a bit now in the second half of the year. So that's definitely the positive aspect. But from a development aspect, certainly, just as developers reacted quite quickly to build to meet all of the growing demand for industrial, they've also reacted relatively quickly to reduce their completions now that it's become quite clear that industrial demand has slowed. Again, I think it's really important to remember that this is slowing demand in the context of outsized demand in the early 2020s, not necessarily slowing demand in the context of the history of the industrial sector. It's still healthy, positive, growing.
That's a very good point. I'm glad you repeated that because that's something we all got to think about. It's like, oh, things are slowing down. Well, that's because they were so hot. And let's talk about sales and transactions and transaction volume. It seems like most every sector kind of cooled down the last few years to roughly 50% transaction volume. But as the brokers on the front end, especially here in the Southeast, we're starting to see an impact of more sellers comfortable, more buyers and lenders comfortable with underwriting deals. And we've seen activity pick up. Are you seeing any trends when you look at transaction volume and cap rates in industrial properties around the country?
Mhm. Yeah, so activity has certainly picked up. Again, it's not to pre-interest rate hike levels, but activity has picked up. There is a lot of activity in the Southeast, a lot of portfolios trading, a lot of properties trading. This is certainly something very positive because they're not only trading, but they're trading at fair market value, not necessarily at discounts like other sectors.
Mhm.
Certainly, the office might be facing at the moment. But so from a pricing perspective, there's that positive aspect. And then of course if we look at cap rates and the mechanism behind cap rates, the interest rate cut in September certainly helped jumpstart the market a little bit because we've seen cap rates fall slightly in the interim after the 50 basis point cut because of course even if the risk premium stays the same, the underlying interest rate has fallen. So that's certainly a positive to help valuations. It also helps borrowers, especially in a time when NOI growth isn't what it was, in the white hot essentially peak of the industrial sector just a couple of years ago. So these are all certainly positive aspects that are helping the industrial sector along from a transactions perspective.
Yeah, that's a good point. Here, we're headquartered in Atlanta, and we do a lot of leasing of commercial properties here, and we're seeing a good selection of industrial properties available for users to lease, but we do not see a lot of available properties for sale. So when we take a property out to market, we certainly get a lot of demand. And as you're mentioning, interest rates obviously impact that. Here we are at the end of October. As you look forward to the November Fed meeting, what's your guess? I know none of us have crystal balls, but what would be your guess on expectations for rates in November at the Fed meeting?
Mhm. So all signs are pointing to another rate cut. And I think it's important to differentiate the signs. So, of course, there are the economic figures like GDP, unemployment, um, which are not necessarily pointing to the need for a rate cut. We've had very healthy GDP growth this year. In the second quarter, it was 3%. Um, Unemployment still remains below the full employment rate of unemployment, which CBO estimates to be about 4.4%. We're at 4.1%. So, the headline uh, economics figures all point to actually not necessarily the need for a rate cut. However, having said all of that, the statements that have been put out by the Federal Reserve, make it clear that they're certainly intending to cut rates. And while they're still very much focused on what the data will say, and of course, we have another PCE print and another CPI print coming up before their next meeting. So inflation, of course, is, of top concern. But that has been trending, positively in terms of in the right direction, in terms of, disinflation, where, inflation is still positive, but it's slowing. And so, really we're getting much, much closer to that 2% price stability target. And that's certainly something that's encouraging them to continue their current monetary policy, which is to cut rates. And their statements have also said that. And of course, if we think about a sector like CRE, where we have had this confluence of slowing rent growth, so slowing NOI growth really across sectors, and then of course a higher for longer rate environment, and then the need for potential refinancing and what that would look like to a borrower. The rate cuts can't come soon enough. So certainly I think it's about the Fed really finding that balance, and I think so far they have, thankfully, which is keeping the economy growing and healthy while also supporting, certain sectors like CRE that need just a little bit more help.
Yeah, a good point. And it seems like one of the Fed's goals is to protect the soundness of the banking industry, for all of us. And it would seem very helpful to the banks to have a rate cut to kind of ease some of this wall of maturities that are kind of standing out there. And I think one of the things that a lot of my listeners would be curious on your thoughts in regard are, as an economist in commercial real estate world, is what might be the impact of the elections if it goes either way? Might there be an impact, since we're talking about industrial, keying on that, or is it just an impact because it's done and we kind of knows where we are? Is there an impact there? What do you say?
So I would say that there's the possibility for many impacts or perhaps no impact at all.
Mm-hmm.
But certainly if we think about crucial topics in that concern CRE, like the 1031, for example, these really should be nonpartisan issues. They're about investment and CRE, and so of course, depending on which way the election goes, that could be a deciding factor in terms of legislation going forward. But certainly there are concerns because the election inevitably has an impact. If we think about things related to, and this is not a political statement by any stretch of the imagination, it's just sort of a hypothetical. If we think about topics like trade, international trade, the potential for tariffs, that could have a variety of knock-on effects in terms of inflation, in terms of the need for more goods in warehouse facilities, for example, to be stored, to avoid price spikes and things like that. So there's certainly these knock-on effects, but I think where we are at the moment, I think regardless of the way the election goes, it will either continue as it has been, or it'll be sort of as it was in the recent past. So I don't think there's any expectation of a big change in terms of something that we haven't seen before.
Okay. Yeah. And I kind of vote economy. I don't like, I don't know that either candidate is tops on my list that I would think should be our president. But, I think when people look at inflation, some of our clients and listeners think that, well, if we're drilling for more oil and we can bring oil prices down, that should really, really help inflation. And when I look at the Harris plan, it is specifically states kill the 1031, that it's for rich fat cats. And which is interesting because it's been around 100 years. And I think cutting it out would severely hurt banks and housing and the tax base, income tax base, property tax base. I think it would be, I think it would put us in a recession. And so it's interesting to see that not only the Harris campaign, but almost every 4 years, somebody's like, oh, let's get rid of the 1031. It's been here 100 years. So hopefully they don't touch that, whoever it is.
It's certainly a lightning rod topic,
Mm-hmm.
sort of at every election. And yes, as you said, it's been around for such a long time. And again, it's one of those things that is about the health of the economy, about CRE investing, and really, I think should stand a bit apart from any sort of partisan discussion.
Absolutely. I agree. Well, what would you leave our audience with to think about industrial real estate in regard moving forward, opportunities, maybe geographic areas of opportunity? What do you say?
Yeah, so I would definitely say that on the whole, still positive, still growing. Um, just not at the the breakneck pace that we've seen in recent years, which I think is always like a bit discombobulating for people because they get used to really strong growth. So when growth returns to normal, as it were, there's some stabilization, some normalization. I think that always is a bit deflating, but nonetheless, putting everything in context, still very positive. And so certainly, if we do think geographically, there are still very many of the usual suspects that are doing, extremely well. We're seeing the best performance in those markets. Phoenix, Houston, for example. But then, of course, especially in Southern California, what we've seen is that because of the amount of new supply that has come online, performance has started to slide. And of course, this can be really thought of as a transition period to where demand will catch up to this new supply. But certainly in the interim, especially in the metros where we're seeing excess supply, it's more than likely that the construction and the completions, in the pipeline are going to slow pretty substantially.
Ermengarde, when you look at industrial and your expectations moving forward, the port strike that kind of, I guess, ended when it should, and do you expect that to come back as a port strike, and do you expect that to have an impact on the economy and industrial real estate?
Mhm. Yeah, so it will, if a strike were to happen again, and if it were to last for an extended period of time, thankfully it was quite short this past month, well, end of September, beginning of October. Um, but if there were to be another strike, if it were to last for a prolonged period, we would see prices really increase. And with increased prices, we would most likely also see, higher demand for storing goods because, if there is the expectation that there might be a risk of a strike sort of on a more continuous basis, which really isn't the case at the moment. But if there were to be that expectation, that would cause, demand to increase to store goods. And then, of course, there's the other factor, which is that, investors, asset managers, and so forth might move to look for industrial properties that aren't in port areas and therefore wouldn't necessarily be impacted because businesses might look to lease warehouse distribution, just general industrial space in areas that wouldn't be impacted by strikes in port cities. Now, having said that, there isn't the expectation. I want to make that clear that, this will be sort of an ongoing issue. Certainly from that perspective, there's stability, but in the hypothetical that I just presented, that of course could be a factor.
Yeah, that's interesting. Think about that makes sense that businesses might want to store more goods near them, and help industrial real estate that's not at the port but near some of these businesses and cities. That's interesting. Well, Ermengarde, thank you for the update and the forecast. As always, great information. Thanks for being with us.
Thank you very much, Michael.
All right. And thank you for being with us around the country. Please let us know what you think. If you will, pay it forward. Share the show with others on your social media and what have you. And if you have a question, idea, a thought for me, reach out to me. My email is an easy one. It's michael@bullrealty.com. Until next week, be sure you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By ShareFile, designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.